All right, people, now we're engaged in a project for cash budgeting, which has huge implication in managerial accounting and managerial finance. So we're gonna do this in the Excel background, and this is your instruction. All right, this instruction is telling you that you are doing a cash budgeting table for a certain month in a year for a barbecue restaurant. All right, that's kind of my favorite. And here you are given the actual sales and expected sales. You see, this is your time horizon from June to September. And any sales before that, like April and May, would be actual sales. And June, July, August, September, and all the way to October are expected. The second part here tells you that 40% of the sales are in cash, and remaining of the sales will be collected in either the following month or 2 months afterward. And it also tells you about the raw materials need to be purchased to facilitate the sales. So the raw material or the inventory would be equal to 50% of the sales in the next month. Yes, if you want to make something, you want to sell something, you better get it ready a month before by making up the inventories and have the raw materials ready to cook. And it also tells you about the delivery plan for the payment of raw materials. How do you pay for your suppliers? Number 4 is about wages. Number 5 is about paying for lease of equipment or these kitchen utensils. Number 6 is about interest payment. Number 7 is about dividend paid to shareholders in a particular month. And also it tells you about a tax payment in number 8 and also a capital initial outlay, which is a huge investment in a month over the project. And also it tells you how you're going to finance the cash balance. And of course, if you spend money, collect money, sometimes you have a lot of cash, sometimes your cash is in short. So if you fail to maintain a minimum cash balance of $15,000, if your cash is too much in short, then you are under financial distress, and you certainly want to avoid that. Okay, so let me just open up Excel first, and we will copy and paste the table to the Excel. All right, so copy and paste. Control C and Control V. All right, Control C is copy from here. Control V is to paste from here. All right, and this is about the information of a sales. Okay, so let me zoom in a little bit so we can see it a little better. All right, and if you read the instruction, it tells you that 40% of the sales are made in cash. So, which means if you are looking at April's sales, which is $291,000, 40% will be paid upfront. So let's say this is your cash payment. Just say cash, that's good enough. And this is 40% of the sales in the current month. All right, and we are going to make all the numbers here in dollar figure. So just put that way, decrease decimals, and I want the format to be Times New Roman. All right, it's just my favorite. Okay, so now let me close my picture so we can see a better picture. All right, for the whole thing. And I can just drag it all the way to October. So right here, you can see that for each month sales, 40% are paid in cash. So that's your cash payment. Okay. And the instruction is also telling you of the remaining 60% of the sales, 75% is collected in the following months, and 25% is collected 2 months after the sales. So which means the first month payment and for April, it is paid in May, all right? So it's based on April's sales. So I'm going to use April's sales multiplied by 60%, which is the remaining payment, times 75%, all right? That's the first payment. And then I'm going to drag it all the way to October. And of course, I'm going to receive the second payment based on the month's sales. So for April, the second payment would be the sales multiplied by 60% times 25%. All right, so drag it all the way to October. Okay, so here is how we collect the cash. For April, let's say there's no previous sales. I have only one cash collected. And for May, I have two cash collected. One is based on the sales in May, and another is based on the sales in April. And then for June, I have three cash collections. One is based on the sales in June, another is based on the sales in May, and the third is based on the sales in April. Okay, and then I can get my cash collection, right? Cash collection. This is going to be the summation of all the three items in the same column. And then I just drag it all the way to October. All right, zoom it out a little bit to see a bigger picture here. Okay, so now we have finished defining the sales and its cash collection in the following month. All right, so let's move on to number 3, the raw materials. So if you want to have some amount of sales, then you would need to get your raw materials ready. This is a barbecue business. That means you're gonna prepare for the meat, veggies, cheese, bun, bread, and so on. All right. So if you want to purchase the raw materials in April, that has to be based on the sales in the following month, which is in May. So if you are going to make 365,000 sales in May, you better prepare the inventory at half of the amount. Okay, and then I can just drag it all the way to September. I don't drag it to October because I have no information about the sales in November. So the raw materials can end in September because October here is the ending sales I have. All right, so that's the raw materials at the dollar figure I need to prepare for each month. And then I have there's a 60% of the purchases are paid in the month following the purchase. The remaining are paid in the following month. Okay. So for the raw materials, you can purchase, you can pay. Okay, let's say first payment is paid in the next month, which is a 60% of the raw materials. Okay, and the second payment is paid in the following month. So that's 40% of the purchase. Okay, so here I can calculate the cash payment, which is the summation of the two. All right, starting in May, summation of the two, first payment and the second payment. You see the first payment is based on the purchase in the previous month, and the second purchase is based on the purchase in the 2 months before. All right, and then drag it and make some distinctions from cash collection. So now I have 2 items established. The third one here would be finished, and then we work on the fourth one. Wages are forecasted to be equal to 20% of the expected sales, and this is an easy one. So let me just do wages. That's 20% of the expected sales. All right, then drag it. That's number 4. Number 5, payments on lease equipment are $10,000 per month. This lease payment, it equals to $10,000 per month. All right, the next part is about interest payment. That's $30,000 on long-term debt due in both June and September. So for the interest, so I have $30,000 here and here, June and September. And then move down to the next, there is a dividend payment to shareholders in June at $50,000. All right, so $50,000 here, that's for dividend. And then you also have a tax payment of $25,000 in June and September. So tax payment $25,000 in June and September. As you can see, the company's quarter ends in June and September and December and then March. So it's the ending cycle of its accounting quarter. All right, that's when the interest, when the dividend and taxes are paid. Okay, so the next one is a capital investment to buy the equipment at $200,000 in July. All right, so this is a long one, capital expenditure, and that's a $200,000 in July. All right, okay, so I can format the numbers a little bit as I prefer Times New Roman font for all the numbers, and also for the numbers down here, I want to make them in dollar signs, showing no decimals. Okay, and before I move down to the next subject, I want to calculate the difference between the cash inflows and outflows. So I'm going to create this an item called inflows minus outflows. And in this particular item, I'm going to use the cash collections from the above as a positive to subtract all the other negative things, so which includes the cash payment based on the raw materials, the wages, and leases, and all of them. So I just use the summation of all of these items. And of course, in certain years, these items are missing, but still, I just want to include all of them. Okay, those missing ones will be recognized as 0. Okay, so this is my inflows minus outflows. As you can see, the company is running surplus in April, in May, and but in June there is a big spending here for wages, leases, interest, dividends, and taxes, and you are running a deficit. And then in July, the situation got worsened as a huge amount of capital expenditure incurred right here. But in August, the situation has been improved, as you see that there is a huge amount of deduction in the expenses, and the company recovered a little bit. And the next subject here is to figure out whether I should maintain a minimum cash balance, and why is that. So you can see that the minimum cash balance is always $15,000 regardless of the month. All right, and if your cash failed to be there, then you have to borrow money, and borrowing money is costly. So one of your job as a managerial finance manager is to minimize your cost of borrowing, of course. So you need to figure out how to fill the gap to meet the minimum cash balance. And then you also need to decide, like right here, you're going to conduct a scenario analysis to find the total amount of borrowing if the capital investment is in June, July, August, and September. So you gotta decide whether you should spend the $200,000 mentioned here in June, July, August, or September in order to have a minimized amount of total borrowing. That's gonna be our next job. All right, here's the deal. We want to borrow money if we are in a shortage of cash. So if we look at this cash budgeting table we just created, and here you got your net cash flows, which is inflows minus outflows. Sometimes it's positive, sometimes it's negative. And the instruction is telling you you need to maintain a minimum cash balance of $15,000 by agreement with this bank. All right. If it's not enough, then you're gonna borrow the money, and certainly more borrowing indicates more interest payment, and that's not good. All right. So here it also tells you that at the end of May, your cash balance is $20,000. So our forecasting period, as is mentioned earlier, is for June to September. Okay, for June to September, and here I'm going to lock the first row, and I will do view freeze panes and just to freeze the top row. So when I scroll down, I can clearly see all the months in the first row, no matter how far I scroll down. Okay, so that's one thing to do. And the second thing here is I'm going to type in the ending cash balance of each month. All right. So the ending cash balance for May is 20,000, and I don't need information here for April and May with cash net flows and the minimum cash balance, and the $20,000 is how much I start with. Okay, and for the rest of the month, of course, I need to maintain a minimum cash balance of 15,000, and based on that, I will determine whether I should borrow money or not. Okay, so there are two conditions. One, okay, if the ending balance of last month plus the net cash flows of this month is greater than $15,000 minimum, then I do not need to borrow. Do you guys agree? I do not borrow. Then no borrowing. Okay, that's one condition. And another condition is if the ending balance of the previous month plus the net cash flows of this month is less than the $15,000, then I would need to borrow. Okay, then borrowing at amount of the gap. Okay, so how do you calculate the gap? The gap basically is the $15,000 minus the ending balance last month plus the net cash flows. So I'm gonna change the name here. Inflows minus outflows. I want to change the name to net cash flows. All right, that's based on all these cash payments and collections in all these activities mentioned. All right, so for June, I'm going to do this. You can see that if I add the ending balance of May, which is just the beginning balance of June, and the net cash flows in June, this is how much I end up with. $1,200. And then I will compare this $1,200 against the $15,000 cash balance, minimum cash balance. If it is greater than that, then I don't borrow. If it is less, then I have to borrow the gap. What is the gap? That depends on how much do I need to get up to $15,000. So it's the 15,000 minus 1,200. All right. So my current borrowing here is 15,000 minus 1,200. All right. So I would need to borrow $13,800 to get the $15,000 cash balance as a minimum. And to get the 13,800, I would need a formula here, and that is called an if statement. All right, that's called an if statement. So we start with the English word if, and this statement is going to imply a logical test. So if that logical test is satisfied, then you will come up with one value. If it's not satisfied, you will come up with another value. So for example, in this case, if the net cash flow of this year plus the ending cash balance of last year is less than the minimum cash balance of the requirement by the bank, then I will need to borrow. And how much do I need to borrow? The amount I borrow would be the minimum cash balance minus the summation of the ending cash balance of last year and the net cash balance of this year. Okay, that's how I came up with the $1,200. So that's when the money I make this year plus the savings I had last year is not good enough to cover the minimum cash balance, and I will just need to borrow the gap. The gap is the 15,000 minus the money I make and the money I have. All right, if it's not true, if the ending cash balance last year, what I have last year from before, and the money I make this year is not less than or greater than the minimum cash balance, then how much do I need to borrow? I will need to borrow 0. So that's a logical test here, and the values when the test to be true or false. So that's borrowing. And then if I want to get the ending cash balance, so the ending cash balance has to be rewritten, then I should incorporate the ending cash balance from last year and the net cash flows of this year, okay, and the borrowing of this year. All right, so if I add all of the three, then I will come up with $15,000, which is exactly the minimum cash balance required by the bank. Okay, so I'm going to replicate the calculation for all the other 3 months. As you can see, in the next year, in July, I end up with $91,400 for borrowing. And where that money come from? Because in July, I had a pretty bad result for cash flows, negative 91,400, and I had $15,000 from before, and I still need a $15,000 this month as the minimum cash balance. So I just need to borrow all my cash shortage from the operations. All right, and then in August, you can see that I make money, 106,500 plus a minimum cash balance of last year. I definitely exceed the minimum cash balance, and so I don't need to borrow. And the same situation happens in September. I make a positive cash flows, and I have a lot of surplus in my ending cash balance. That's definitely exceed the $15,000 minimum, so I don't need to borrow. So the amount of borrowing for August, September are all zeros. All right. And then I would need to calculate the amount of a total borrowing, which is the summation of the two, actually of the 4, okay, and 2 of them are zeros. Okay, so that's my total borrowing happened in June and July. And that is the situation right now. If you look at the instruction, it also tells you what about, okay, what about if I put the capital investment, which is $200,000 mentioned above in June, July, August, or September, would that change the situation? So right here, you have a capital expenditure in July. If I put it as 0 here, I don't spend the money in July, but instead I spend the money in September when I have more money. As you can see, if that $200,000 is placed in September instead of July, then my total borrowing is definitely much less. So what about if I put the $200,000 in June instead? Then you can see that I would definitely need to borrow much more money compared to spending the money in July. So this is just recoup it. Okay. So this is the original situation. The capital expenditure is $200,000 placed in July. So now we're going to conduct a scenario analysis. And in the scenario analysis, we're having 4 scenarios. Each scenario has the $200,000 in 1 month. So 4 months means 4 scenarios. So this is exactly what you're going to do. You're going to hit data, and you're going to choose what if analysis, and you will see scenario manager. It's right here. Okay, and you want to add all these 4 scenarios. The name of the first scenario is capital expenditure in June. Okay, and you're going to change 4 sales from the month of June to month of September, and these are all within the role of a capital expenditure. Okay, so if that happens, then for D16, you're gonna put it as a 200,000, and for all the others, you put them as 0. So this is your first scenario. In the first scenario, you define the name as expenditure in June, and then you put the $200,000 in the cell here under the June column, and all the others would be 0. And then you're gonna add another scenario. It's called expenditure in July. You still gonna edit the same sales from D16 to G16, all these 4 cells, and they're gonna have a different layout. So for D16, the capital expenditure in June is 0, but for E16, the capital expenditure in July is 200,000 as the original setting. All the others would be 0s. And then I add another scenario. This time it's called expenditure in August. And still changing the same sales. The only difference here is the $200,000 is moved down to the 3rd month of the row, which is August. Okay, so this is how we define it. And then the last scenario, we call it capital expenditure in September. Still by changing the same cells, don't change that. And then all the cells are 0s except the capital expenditure in September. All right, and now we have defined all the 4 scenarios. But what's the point after we defining all this spending of each month under different scenarios? We want to observe the total borrowing. Okay, we want to observe the total borrowing, and you should hit this button. It's called a summary, and you're gonna observe the total borrowing here as the result cell. Then you hit OK. All right, and now it just come up the result. So here you can trim it a little bit, delete some cells. So D16 is the expenditure in June, and then followed by July, September, August, and then September. And here the result cell is total borrowing. So as you can see, the current value here is the $200,000 is spent in July, and I can do 4 scenarios, either in June, August, or September as other cases. As you can see that for the total borrowing under each scenario, the amount is different. The amount would be the least if the $200,000 is spent in August or in September. So that makes sense, right? You want to wait until you have enough cash in your pocket to spend the $200,000 on equipment, because that's not smart spending. And if you spend prematurely when you don't have enough cash in your hand, like right here in June or in July, that's going to cause you to borrow a lot of money and pay a lot of interest. So that's the meaning of managerial finance and accounting. So how to manage your cash resources smartly.